Back to my YouTube channel. This video is for CA Foundation. Here we are going to see the important journal entries or the most trickiest journal entries, and these are very important for Jan 2025 exams. Please do subscribe and follow for more such videos. And if you want to take my classes, then you can see my number in the description box. You can directly reach out to me. So let's get started. So employees have taken in the first one. This is very tricky one. Okay, employees have taken inventory worth rupees 1 lakh. This is the market price, and the cost price to the company is 75,000. Okay, on the eve of Deepavali, and the same was deducted from their salaries. Okay, in the subsequent month. Now let's break this down further and understand it in a better way. Okay, now the inventory is given to the employees, but at some point of time the company must have purchased the inventory. Then at that point of time, what must be the entry passed by the company? So in that case, no, company must have passed purchase account debit to bank account. This is when the company has purchased the inventory. Okay, when the company has purchased the goods, the company must have passed purchase to bank. Now in the eve of Deepavali, what it is doing, some companies will give biscuits, chocolates and all, no? So this purchase what company has done at the beginning, now it is giving to its employees. Okay, when it's giving to its employees, you credit purchase account. Earlier you have debited it, right? Now you're crediting it, purchase account credit. Okay, till here it is clear. Now is the company getting cash? Now it is giving to its employees. Is it getting cash? No, it is adjusting against their salaries. Okay, it is adjusting against their salaries from the future. Now let's understand. Suppose an employee's salary is 1 lakh. Okay, in the next month, 1 2 3 4 5. Okay, now before paying this 1 lakh rupees, they will adjust 75,000 there. Since cost price of this inventory is 75,000, right? So this 75,000 is adjusted against the future salary, and then the balance will be paid. 25,000 will be paid to the employees. Okay, now what is happening here? The inventory worth of 75,000 is given in the current month, and the same is adjusted against their salaries. So that's the reason it's like they're giving 75,000 worth salary in the current month. So you debit salary account. I hope this point is clear. Okay, and we take only 75,000. Okay, market price, we're not concerned with this 1 lakh. Okay, so 1 lakh in a market price, we're not concerned with that. Whatever the company has purchased at the time of purchase, company must have spent 75,000, and it has paid 75,000 at the time of purchase. So now it is giving to its employees. So we are only concerned with the cost price and not with the market price. What is the market value of the inventory? We are not concerned about that. Okay, at this point is clear. Now let's go to the other one. So your basically wages is paid for erection of machinery. So whatever cost is involved to put up an asset, till the time it is put to use, all that cost will be capitalized to the asset. So erection charges also is erection charges happens when you're putting up an asset. Okay, so that cost shall be capitalized to the machinery. So that's the reason when you're capitalizing the cost to any asset, the asset value is increasing. So when asset value increase, you actually debit the asset. Okay, in case if there is any increase in the asset, you debit to the asset. Okay, to bank account, your money is going outside, so asset value is decreasing, so that's why you're crediting it. 18,000, 18,000. Perfect. So income tax liability. So understand, income tax liability of a proprietor is not a business expenditure. It is his personal expenditure. So whenever any personal expenditure is done from the business bank account, no, so that has to be debited to your capital account as drawings. Okay. So now here income tax liability is paid via petty cash. Okay. So here in this case, drawings account will be debited. Okay. You debit drawings account. Okay, drawings account debit by 17,000. Okay, to petty cash. Okay, 17,000. So basically what happens to this drawings is, in the future, from capital, this drawings is debited, since he has used it for his personal things, no? So the amount will be reduced from his capital. Perfect, no? Let's go. Now another one is purchase and purchase returns. Let's see what happens. What is the journal entry in case of purchases? So at the time of purchases, the journal entry would be purchase account debit to bank account, right? Suppose out of that purchases, you didn't like those goods and you're returning back. Okay, in that case what happens? Your money you will get back, so that's the reason you're debiting bank account to purchase returns. Purchase returns you are crediting. I hope till here it is clear. Now we will see the same purchase and add even GST also to it. Okay, now let's understand in the other journal entry what is happening. Okay, so here in this case, no, purchase goods from Sam, you're purchasing goods worth rupees 40,000 and you got a trade discount of 10%. Paid even CGST and SGST 9%, and you paid only 20,000 immediately, and the balance is paid after 3 months. Okay, now you got trade discount. Okay, trade discount is something which is not shown in the books of accounts, but a seller will offer a buyer in case if he has done any bulk purchase. Okay, so for purchaser, if I'm purchasing the goods, the normal price for me would be after trade discount, that is 36,000. 40,000 minus 10% is that comes to 36,000. So purchase account debit. Me as a buyer, I will debit purchase account debit 36,000, and on top of that I'm paying even CGST and SGST. So if you have paid at the time of purchase any GST, that can be used against your output tax liability in the future. So this amount that you have paid now at the time of purchase is actually your asset. Okay, because you are utilizing again the output tax. Okay, so that's the reason input tax, CGST, input, SGST. You will be SGST. You will be debiting this too. Now 36,000 ke upar 9%. 36,000 into 9%, that comes to 3240, 3240. Okay. How much did you pay the amount? Did you pay the entire amount? No. It says you have paid only 20,000. Okay. Where is that? You paid only 20,000 and balance will be paid in the future. Understood? To Sam. Okay, whatever is the balance into 2 plus 36,000. So balance would be 22,480. Clear? Perfect. Now let's see another one. So here in this case, no, you did purchase. Okay. Now here you are doing returns. Goods costing 5,000 before trade discount. मतलब उसमें से trade discount हटाना, and then it has been returned to Sam. Okay, the same creditor. Okay, now it has been returned to him. Okay, when you are returning, earlier you credited, creditor. Now you have to debit him. Okay, Sam will become Sam account debit. We will see the balance. Now how much did you purchase before? Earlier purchase. See, in case of purchase, we debited purchase. At the time of returns, what did we do? We credited purchase returns. Same thing happens now. So here we did, here at the time of purchase, we have debited purchase account. Now we will credit to purchase returns. Okay. And then at the time of purchase, no, we have even debited input tax. Now you're not eligible for that. You have to reverse that also. To input, to CGST, to input SGST. I hope even this point is clear. Now let's understand how much worth rupees you have returned. Okay, I have returned 5,000 minus 10%. 4,500 worth का goods I have returned. उसके ऊपर I have even paid CGST and SGST at the time of purchase. Even that has to be reversed. 9%, that comes to 405, and here it is 405. So total comes to 5310. I hope this point is clear now. Okay. Right, simple. You whenever you have whatever you have debited at the time of purchase, no, that has to be credited at the time of returns, including CGST and SGST. Nothing is difficult in this. Okay, it's simple. Chalo, now we'll understand what is this purchased machinery. Okay, they have given the party name you have purchased from Miss Symphony for 1,40,000 rupees. You paid CGST and SGST also, and paid 1 lakh immediately, and balance will be paid in the future. So at the time of purchasing machinery has a debit value since it's an asset. So you will debit machinery account debit. Right, now at the time of purchase, if you're paying CGST, SGST, that is also your debit, that is also your asset, because that you can utilize against future output tax liability. So whatever input tax that you have paid, input CGST debit, input SGST debit. So what is the cost of the machinery? 1,40,000 rupees. Okay, on this you have paid 9%, 12,600. Okay, and then again another 12,600 you have paid at the time of purchasing the machinery. Now how much did you pay? Did you pay the entire amount? Your bank balance will come down, right? So that's the reason you're crediting your bank. Okay, so you paid only 1 lakh. and balance what happened you will be paying in the future. So he becomes a creditor. Who becomes your creditor? The party becomes your creditor. You are liable to pay him in the future. Okay, symphony. Okay, whatever balance comes now, 65,200 is your balance. That has to be credited. Okay, it's simple, very easy. If this video was helpful, please do like and subscribe and share with your friends. And for any personal assistance, please do reach out. Let's go. Thank you. See you all soon.